Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for September 9th, 2018. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 0.91 fell from 1.22 last week. The total count of securities in bullish or bearish patterns increased 3% to 3,139. The count of bearish stocks increased 20%, while the count of stocks in bullish patterns decreased 11%. The Pirls PNF Market Breadth Summary Chart shows us a market 1 week in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompt. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 32 points for the 9th decline in 13 weeks. At a positive 254.80 points, it has fallen below the March 2018 and July 2017 tops, and continues below the 6 remaining tops above plus 100 in the last 30 months. And it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The CCI 20 daily, at a negative 11.48, fell from a positive 160.18 last week, after forming a Woody's zero-line reject long entry signal at Thursday 8/16 close, in a continuing Woody's uptrend. At Wednesday 9/5 close, the CCI 20 daily fell below plus 100, so we exited the trade at Thursday 9/6 open. The result of this trade simulation was a gain of 211.63 points on the Nasdaq, or $4.18 per share of QQQ. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 123 weeks ago, while the daily CCI 20 began a Woody's uptrend 8 weeks ago. The CCI 20 weekly fell to a positive 100.27 from 140.60 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. 4 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: S&P retail and banking on top. Oil, gold and silver, and some tech on the bottom. Bullish, S&P retail continues in the top 5. KBW Bank and computer hardware have left the bottom 5. KBW Bank has entered the top 5. Gold and silver has re-entered the bottom 5. Oil services has entered the bottom 5. Bearish, networkers, semis, disk drives, and comp tech have left the top 5. Disk drives has entered the bottom 5. Focus this week from www.dollarcollapse.com. Even mortgage lenders are repeating their 2006 mistakes. The following are some key points with a chart. You'd think the previous decade's housing bust would still be fresh in the minds of mortgage lenders if no one else, but apparently not. One of the drivers of that bubble was the emergence of private label mortgage originators who, as the name implies, simply created mortgages and then sold them off to securitizers, who bundled them into the toxic bonds that nearly brought down the global financial system. The originators weren't banks in the commonly understood sense. That is, they didn't build long-term relationships with customers and so didn't need to care whether a borrower could actually pay back a loan. With zero skin in the game, they were willing to write mortgages for anyone with a paycheck and a heartbeat. And frequently, the paycheck was optional. In retrospect, that was both stupid and reckless. But here we are, a scant decade later, and the industry is headed back toward those same practices. Today's Wall Street Journal, for instance, profiles a formerly minuscule private label mortgage originator that now has a bigger market share than Bank of America or Citigroup. From a broader societal perspective, this is par for the late cycle course. After a long expansion, most banks have already lent money to their high-quality customers. But Wall Street continues to demand that those banks maintain a double-digit earnings growth and will punish their market caps if they fall short. This leaves formerly good banks with no choice but to loosen standards to keep the fee income flowing. So they start working their way toward the bottom of the customer barrel, while instructing their prop trading desks and/or investment bankers to explore riskier bets. Misallocation of capital becomes ever more common until the system blows up. The signs that were back there, 2007 in some cases, 2008 in others, are spreading, which means the reckoning is moving from inevitable to imminent. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Sand to Pearls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have enjoyed a peaceful and pleasant weekend and that you are now prepared for a prosperous and productive week coming up, and wishing you true success.